Now, this is a great example as to why Benjamin Graham says that in short term, the stock market is none other than a voting machine. That's because if you look at in terms of yesterday, DBS lost more than 3%. And not only that, if you look at this article, DBS, UOB, OCBC all lost more than 3% simply because MAS requested for cap in terms of dividend. Now, this is just a request to cap. It's not that they've lost money and they are unable to pay dividends. That's why naturally people are asking this question. Is it a good time now to be buying in the banks? Is it a good time now to be buying the DBS? You may have this question also. So today, I'll try to help you answer. But nonetheless, when we look in terms of banks, there's always these sophisticated terms that come about. What is this? Capital adequacy ratio, loan allowance coverage ratio. These are terms that we don't understand. Instead, I'll give you breakdowns. I'll give you firstly, what is the dividend cap for DBS and what banks around the world are actually forced to do. I'll also show you an example for a bank that almost went belly up many years ago. And last but not least, I'll give you quick conclusions. I'll show you exactly how resilient DBS Bank has been throughout these years. And if this interests you, continue watching on. Hi guys, welcome back. Now, if you speak to any retiree and you ask them the reason why they are investing in banks, they'll tell you it's because of dividends. And DBS actually pays handsome dividend. Last year, they paid $1.23 per share. But this year moving forward, there's going to be a cap. And if you haven't seen the news already, MAS requires the cap to be 60% of 2019's dividend yield. In addition, they are encouraging banks to issue scrip dividends instead to conserve cash. So why is there need to conserve cash? If you don't really know, banks are very important to our economy. They circulate money. They actually do lending, which means if money is circulating through lending, there's every chance that, it's like blood to the economy. It encourages a recovery from this COVID-19 crisis. So that's one of the main motivations in my opinion. Now, as we look back in terms of dividends, DBS has actually communicated they are only going to pay 72 cents per share moving forward according to this guideline. And if you invest DBS today at $20, for example, the dividend yield is 3.6%. Now, is 3.6% good or no good? That depends on you. But in a lot of ways, DBS is a very sound company. How sound is it? DBS, if you don't really know, is Asia's safest bank. And I actually went to do a curious check. Who in the world is the safest bank? And it's actually a German bank. DBS is ranked number 14 globally. So I was thinking about this topic. I was thinking, is MAS being too prudent? Is our Singapore government being too reactive? But it's actually not true. The German bank, which I mentioned is the number one safest, is also being asked by Germany government to actually cut back on dividends. What about for England? What about for Bank of England? They've actually asked UK banks to cut back also on dividend. So this is not only to Singapore. So about more recently, Fed in the US has actually asked banks to also suspend share buybacks and cap dividends also. So it's all around the world. So it's not only in Singapore. In fact, we are one of the later countries to really issue this cap in terms of dividend payouts. And when I look at the list of the world's safest banks, I was surprised. US only has a couple of banks there, and the couple that is in those lists are all the smaller banks, not the big banks. I know Warren Buffett, he owns Wells Fargo, and Wells Fargo was a share that I tried to pull up in this chart for you to see. End of June 2020, Wells Fargo actually had this cap being issued onto them, and share price has actually stayed flat moving forward. So will this happen to DBS share price? I don't know, but when it comes to investing, always invest for the long term. So in the next section, I'll touch on a company which is also in US, a US bank to be exact. And if you don't really know that story, that is regarding CITIBANK, who many years ago almost went belly up. Now in this section, I'm going to share with you a little bit of CITIBANK's history. Back in 2008-2009, there was actually an analyst who became very famous. Her name is Meredith Whitney. I remember seeing this that years back, and that really stuck with me. Meredith Whitney actually made this bold call that CITIBANK has to cut its dividends simply because she's projecting big losses. Now, right now, DBS, they're capping dividends. It's a different scenario. They're not incurring losses like what CITIBANK had to suffer because of mortgage crisis. This article really shows 37.5 billion losses in the 15 months that ended before in 31st December of 2008. Now, Meredith Whitney won a lot of accolades for making that call. This is the share price of what happened in CITIBANK, because many people expected CITIBANK to be able to survive, and many people didn't anticipate that kind of losses coming. And CITIBANK has never recovered to its heydays. So in a lot of ways, this goes to show you, if banks are being asked to hold back on dividends, there's a different scenario from a bank that is cutting dividends simply because they are incurring losses, they are bleeding money. So these are two different scenarios, and hopefully that gives you some perspective. Now in this next session, I'm going to help you understand DBS or investing in DBS, what to take note. I have 3 key points. The first is you should expect default rates is going to rise. I have case studies for you to see. Let's look back in terms of 2008, 2009. That's the global financial crisis. In a lot of ways, that was a banking crisis. Today, we're seeing a possible economic slowdown. There are 2 different cases, but what we can learn is every crisis will also present that non-performing loan rates will shoot up. Back in 2008, 2009, that also occurred, which means news articles are going to come out that default rates, etc. Analysts are going to say, the margins are going to shrink. So you should expect that if you are interested in investing in DBS. Next couple of quarters, default rates are going to go up. What next to take note? If you look in terms of this chart, this shapes your expectations in many ways. 2008, that crisis, it took more than a year for things to recover. In fact, they actually lost about 20% in terms of profitability. This is actually a chart for DBS specifically. And it took 2 years for them to recover. Later part, I'll show you how fast, or rather how much they have recovered since. So this actually shapes your expectation. Do not expect profitability to recover in a couple of quarters. It could take more than a year. So that's a key learning point. And especially if we see certain risks, oil and gas risks. This article shows that back in April 2020, it was declared that DBS has a portfolio in oil and gas of $23 billion. I shouldn't validate that information for you already. This article, DBS research on DBS itself, so hopefully it's accurate. But DBS has the biggest exposure in oil and gas across all 3 banks. But nonetheless, it's still looking like 6% of its total loan portfolio. So they could be the ones that's really dragging up this non-performing loans. And when that happens, hopefully you're ready, because today we had this discussion ready. The second key point that I'd like to share with you in terms of layman terms is Singapore banks are very resilient. Singapore banks have been through Asian financial crisis, they've been through dot-com bubble crash, they've been through global financial crisis and emerged stronger. So Singapore banks are really backed by government. But I have something interesting to show you. This is actually back in Asian financial crisis. What happened back then? There was this property bubble that happened across Southeast Asia, and DBS, while having a lot of mortgage loan and stuff, actually showed a massive drop in terms of profit. That was 1998. That was when I was quite a lot younger. So back at that point of time, they actually still managed to eke out certain profit, and that was the time whereby DBS merged with POSB. So a very interesting story, but nonetheless it shows you banks are backed by government and they will survive. It's very hard to bet that they will actually fall and go under. What about for non-performing loans? I don't have that data, but I can show you back in terms of Asian financial crisis and dot-com bubble crash, the non-performing loans were much higher at 7%, 5%, thereabouts. So don't be too alarmed, and they can still survive even with that kind of horrific numbers. So the third key part I'd like to share with you in terms of layman is banks will lead the index in terms of recovery. Why? Because banks are they circulate the blood, which is the money to the economy. So when they start to do well, they will start to recover in the share price. Then many other sectors tend to follow. This has happened many, many times. And how fast did that rebound in DBS performance actually happen? I have this to show you also. Back in terms of the global financial crisis, 2007 was where things started to turn bad. 2008, 2009, if you followed until here, you realize that they were slightly poorer years, but nonetheless they eked out profits. But 2010 was a record year. They shot back up, things were starting to look green again, shoots were starting to sprout out. So that was a record year, and it only took 2-3 years for things to recover. So when it comes to investing, I've always mentioned, invest long term. You have to look past a current pandemic. And if 2-3 years is all it takes, current earnings per share, 2019 earnings per share, $2.28, if they can surpass in a couple of years, is today's share price at $20 expensive? It's very hard to say that it's expensive. But is it the bottom? Nobody knows. But in my opinion, it's very difficult to say $20 is expensive as a share price, because earnings per share is going to be at $2.28, it's going to be exceeded, in my opinion, in a couple of years' time. So hopefully that gives you some perspective. And if you're keen to learn more about what I mentioned about OCBC, as well as why invest in STI index and buying a particular bank, follow this other video which I've done previously. Hopefully that gives you a lot more insights. So with that, I'll sign off. Smash a like if this helped you in one way or another, and share with any friends who are curious. I'll see you in a future video. Take care and goodbye. Goodbye.